Today's video should be an overall market update rather than only an intraday update because yesterday in the Nifty Daily I discussed the idea that you'd completed an ABC on the Nifty daily charts, and that same setup showed up on several sector charts which I will try to show and cover. So I think it required a discussion as to what are all the factors that I'm looking at right now, because I started the month with a long short report that looked at the whole of month remaining positive, and we've achieved the first target and overshot it within days, and we're not too far away from the second one. So as we enter that stage and we have a major event coming up, I think it's critical to understand exactly what's going on, at least on various technical readings. So which I'll try to cover. I'm starting with what is the OI put call ratio, something I've published in the long short report several times, and on this report, on this indicator, what I'm showing here is that you've reached a point which has marked most of the recent near-term tops, and probably done so even in the past, and uh, therefore this is one among many indications that you're closer to the highs than the lows in the market. We can continue to debate whether it's already topped yesterday at 5930 or whether it'll stretch till 6000 before doing so in some kind of a continuation. Will we get ABC x ABC? But that the largest part or the best part of the move is over causes us to raise red flags, and there are many other indicators which are already doing so. So let's look at the next one. The next one is the IV, along with the Nifty. Note that the IVs bottomed in January when the market actually topped out here. At least the broad market made its highest level in Jan of 2013. The Nifty did come back to those highs and go a little above that in May. However, the IVs continue to make higher tops and bottoms, which have marked as T1, T2, T3, T1, B1, T2, B2, marking higher tops and bottoms. Now what essentially happens is that each time the market pulls back on a rally, you see IV stabilizing, making a higher bottom, but actually going down during the rally. What we've seen this time round is IVs actually remaining stable at a much higher level, above the 20% mark, between 20 and 30%, and the market has already retraced a significant portion of the losses that we saw earlier on, and this remaining high means volatility in the market remains high, and whenever a move down starts, it would also have speed. So high IV on this bounce back is actually could be a warning sign that you actually quickly retraced, and this is an XB wave in any case, and the next leg down, maybe it's C2 and C3 down, could actually start. I've discussed various alternates on the currency, and I keep marking them based on different possibilities. And one thing that came out clearly is that the 40-day moving average near the 63 mark, if it holds, could become a potential point from where you could get another move up in the currency. Whether it's a fifth wave or a B wave, we could figure out, but either case means going up to 66 half or going all the way back to 69 in the coming days, and therefore this low point here, 62.91, is a good stop for the long trade on the USD INR, and typically the market's gone through a weak phase when that has happened. So this is another indicator that there could be some pressure in the market. There's a variation of count between the broader indices like the mid cap and the Nifty. On the Nifty, I showed ABC yesterday, but when we look at a mid cap index, what we see is an expanded flat. Similarly, on the BSE small cap index, so we're marking that as A, B, and 1, 2, 3, 4, 5. So yesterday, at least on most mid cap indices, we saw a three-wave decline, which can be marked as wave 4, as shown on this chart here, and wave 5 is in progress. And as and when, and which is where you're seeing some good breadth today, even as the index is under pressure. The broader indices are all positive, up to half to 0.6% up, and they're trying to complete those final legs which were not complete. I showed this chart many times in the nifty updates when we are calling a bottom, looking for the intermarket, showing the intermarket divergence and counts. It essentially shows the same thing, that the recent run up. Now we've completed ABC on the nifty, which is here. However, on the mid cap and small cap index, it's possible that we are still doing a 3 and 3, 4 and 5, depending on how you count it. It's possible on the BSE, and it's possible on the BSE mid cap that you completed C. Also, we would have liked to see a lot more strength in the broader indices during this bounce back, and once again, just like we saw in both April and in June to July, when the markets rallied, the broader indices simply retraced some of their losses and then continued to head down. So far, that's all we are seeing. The Nifty is back, having retraced 78% of the losses that it made in July to August. Whereas the broad market indices have not even retraced 50% of that. So you continue to see general weakness in the broad market, even as they have quickly moved up quite a bit. In fact, I would say they've moved up equivalent to what they did in April, based on just the size of the move. Just to show you a measure, if I simply measure the entire rally in April, May, and I put it to where we are today, then even though it might not appear like the stocks have done so much, the index has actually moved up an equal amount, and therefore even though we've not done the entire 8 weeks that the mid cap indices took from the March low to the May high, so far the entire move from probably the early August to now is around 1, 2, 3, 4, 5, 6 weeks. That's 2 weeks shorter, but we are already done an equal amount of move in this time period. So there again, since we are already very close to the targets, if you even do stretch for some time in terms of price, the upside could get limited. The US stock market, one that's continued to head higher against most emerging markets. In the sell-off that we saw in August was the first time we were able to spot on the daily charts a 5-wave decline. So that was the first warning that you had a major top probably in the US market. So on the S&P, essentially I was looking for a retracement. However, on the transports, I was saying that you can make one more new high. But then you can't be right on everything. What you do have here now, again on the S&P and Dow, and I'm looking at the S&P right now, is a minor 3-wave A, B and C after that 5-wave decline, and we've retraced 78% and hit the upper Bollinger Band on the daily charts. Now typically this kind of setup on any chart would be a warning that if wave 2 is complete here, then wave 3 down is ready to start, which means the S&P is ready for a bigger sell-off out there. And if that is true, if these highs hold, which is around 1690 to 1700 is not crossed, and you start seeing selling on the US market, then we should start looking for a third wave decline, which then goes all the way down to 1600 or even lower, and that would put pressure on most world markets. So I think from this 78% retracement, as far as the S&P is concerned, you have the risk of a third wave down starting, which could be extremely negative for most world markets. So that brought me to the exact theory that I discussed many times over in previous updates, that if the market's bearish, all you need to do is look for ABC up and look for the next leg down. Will wave C become a wedge and waste time? Will you get an XABC extension on the upside? Is something we cannot know, but what we can know is that we've completed a 3-wave structure on the key indices. This is the Sensex, where I can easily mark an ABC up, and if the next leg down is to start, then this is a good point. And there were many other indices like the sector indices, which had to complete particular moves, which I've been writing about from time to time, and many of them did actually achieve their required targets. This is the auto index. I was showing a broader triangle on the auto index on a weekly chart, and I was mentioning that if it's a triangle, it might go to touch the upper end closer to the 11,100 mark, which it has done, mostly because of Tata Motors running up to its long-term wedge line and touching it, and having done so, this pattern is complete now. Unless you actually break out above the 11,160 mark, this triangle would appear complete. Similarly, on the banking index, the current rally after what we marked as a 5-wave decline, note that the second wave was a very small retracement, and therefore the fourth wave here was to be a deeper retracement. It could have done 61%. It's almost come close to that, just short of 61%, and appears like a 3-wave rise from the lowest point in late August. We see a very similar structure of a wave 4 up in the capital goods index, which can also be marked as A, B, and C, and possibly that wave 4 completed. Now, wave 4s, you can argue, can be time-wise triangles and can waste a lot of time. That's the only situation in which the immediate big sell-off may not happen, and if all these indices go into a triangle structure before a sell-off. Otherwise, in most of these cases, once wave 4 is complete, you should see a down move. One of the reasons I wouldn't expect that is that wave 2 itself was a sideways flat pattern on several indices, and therefore wave 4 was likely to be a deeper retracement, which it has been in most of these cases, coming close to 61%, and therefore not what you typically see in triangles, which is a sideways structure. So I wouldn't really expect a sideways structure. If these ABCs are complete, then you would expect the fifth wave to start from here. The marking on the power index is also very similar, that of a larger third and fourth on a longer term chart, and similarly on the reality index, my marking has remained that this was a fourth wave, although I thought there was potential for a, in some stocks like DLF, I thought there was a larger 5, but we can't really see that on the reality index. There seems to be a missing fifth wave for the entire sell-off that started from January. Among other important indices, the FMCG sector, which has been one of the most attractive last year, did show a 5-wave decline during July-August after it made its highest point in July, and in the recent run-up, apart from the IT index, I don't think any of the other indices really made a new 52-week high. So the IT index has been the only performing index of this time period, and so far again here it's possible to mark this rises A, B, and C. We haven't reached 61%, so unless there's some kind of stretch in the C wave towards that mark, which is closer to around 6700, we would be looking for 6900, 6975 to be exact, and then that's what we would be looking for maximum in C if it completes a larger retracement. Otherwise, ABC at yesterday's high looked like a completed pattern here. And lastly, I covered the BSE IT index yesterday. It had attempted to cross the 8,000 long-term wedge line last week. However, it just closed above that for a day and then sold off, and then you have daily indicators going into sell. So I would think that probably that was a false move, and wave 5 of C of E, as you would call it, for wave E of the wedge is complete, and it's a multi-year wedge that we are looking at for a very, very long time frame, and its completion should mark the beginning of a decline phase. So unless these highs are taken out, some other alternate count comes in, this should be the beginning of a further decline for tech stocks. So another index, and that probably the last one that was making new highs, if it gives up, would reduce the potential for the index to be able to make higher highs every time, as it has done over the last several years against the broad market. So that catch up between the broad market and the large cap index would happen once the last outperforming sector actually gives up, and the failure of the IT index would be that signal that every sector has stopped participating. Pharma might be one of the odd guys where if something different happens, you would have to keep an eye on, because I don't have a confirmed perfect 5-wave decline. So while I'm still looking for that on the pharma index, there is a chance that it's done too, as the fifth wave on the way up appears complete. We just don't have confirmation that a down leg started, unless some kind of distribution pattern is occurring on the pharma index. But among indices that made new highs, the only one was IT in the last 2 months, and give up of that would mean that every sector has given up, and all of them in the recent bounce back, as I've shown, have made ABC or 3-wave advances, and that puts us at a critical point to uh, decide that a three-wave run-up completing means that the market has topped and or is in the last phase of topping, before which the larger C3 down wave can start. And let me mention that as and when it confirms that C3 down is starting, and it would mean that we're not just going down to 5700 or 5600, it means we are going to break the 5100 mark. Let me just look at Nifty to cover that. So here this is the chart of Nifty, and for some time I've marked this decline as A, B and C, and the run up could be an X wave, a C wave or a B wave, or a 2 wave. There are many ways that we could have counted it, and depending on where the final top is put, I will mark one of the counts, but at the current level, at a 78% retracement, I can very well mark this as C2, and which is what I wanted to do throughout August, and start looking for C3 down. And even if it's ABCX, then we would start looking for a fresh ABC down. In any case, the next impulse leg in such a structure would mean breaking at least the previous low, which recently formed very close to 5100, which means we are looking at a move that could go below the 5100 mark, and in doing so, several targets would open up. If we simply take equality to the initial leg, that itself would give us a target of around 4865, and typically as you are entering a third wave, targets will get exceeded. So the whole object is we're looking for a top. It's either formed here, or if we see some kind of stretch 259.50 or 6000, we would look for it completing there, and as and when the next leg down starts, it would mean going below 5100 all the way to 48.50 or lower, and that's the move that we would really like to catch, as there are fifth waves pending across several sector indices and the USD INR, and it would also involve the starting of a major sell-off in the US market. So that's the net of what I saw on most charts that has been bothering me, and it highlights the risks ahead from here, because we've already moved up quite significantly on the main index, and the upside potential, however limited, might not favor in terms of risk reward. And also you might get a lot of stock rotation if the index does continue to stretch up, that what you buy might not really give you the returns that you're looking for, and something else might move and there would be other stocks falling, so you're going to get rotation near the top again, and the best part of the move on the way up is probably behind us. That's all in this update, a pretty long one, but covers a lot of charts, so that you get an insight into what to expect ahead, because the last long short report was relatively highlighting the upside potential, but that doesn't really change the long term bear market view. So this should be an update to that long short report. Thank you.